Hello, hello. This is Peter Nelson with Nelson Insurance Advisors, and of course we have uh, Logan Hertz here from Hazeltine LLC. Hi, Logan. How you doing?
Hey, Peter. Good to see you again.
Well, it's great to have you, and thank you. Actually, I should say it backwards. Thank you for having me. And we're going to be talking about financial malpractice, part two. We were having such a great time, and I thought it would be good to break it up a little bit. So here we are. Logan, would you mind real quick just summarizing, what we talked about a little bit?
Yeah, we have a prospect who, does something that is not uncommon, wants to, gets introduced to the infinite banking concept and wants to check it with his financial advisor. And then the financial advisor comes forth with a lot of misconceptions that are fairly typical. First of all, claiming to understand a concept that he really doesn't understand, confusing the concept with the vehicle, which is cash value life insurance, and then looking at cash value life insurance as an investment vehicle, which is not what it is. Not to mention the lack of a real comprehensive plan that would incorporate things like a long term care plan and, as Don Graves would say, housing wealth. How do we make use of one of your best assets, which is your house? So all of those themes come together, and I think this is just very instructive for people to understand what sets people like me and Peter apart in the financial industry.
Absolutely. So let's get back into this here, and I think where we stopped was we were talking about life insurance. Is it expensive? How does that all work? We've already talked about that. Look at our financial malpractice part one if you want to find out about that part. But I think what we're going to get into next is, um, if I'm correct, I believe the advisor had said something like, although most insurance brokers um, use these types of policies as an investment, you're essentially making an actuarial bet that you die sooner than statistically predicted. This is a bet often lost by the insured, as evidenced by the relative profitability of insurance companies. So there's a lot there. Um, Logan, what do you think about what he said there?
Yeah, so Peter was quoting from the email from the financial advisor, and there's so much wrong there. I just don't know where to begin. Okay, but let's start with, again, first of all, just to can't emphasize this enough, he's confusing the infinite banking concept with cash value life insurance. Okay, two different things. And now but when he jumps into cash value life insurance, he shows so many misunderstandings. So first of all, yeah, although most insurance brokers couch these types of policies as an investment, that's what he says. Well, I don't know what insurance brokers he's working with, but cash value life insurance is not an investment. It has never been an investment. Okay. It is not that. And I think compliance departments at insurance companies would not be very happy if they
Well,
saw any of their agents saying this is an investment. It is not an
right.
investment vehicle, right?
And let's be
That's
fair though,
really
real
important.
quick. I'm sure you would admit too, Logan, there are people on, and I don't even look on there, but I've heard there's agents on places like TikTok and other social media things that they're touting that, for example, indexed universal life is an investment, or it acts like an investment, or I've even heard people say that it can outperform an investment. And just like you said, it is not an investment, has never been an investment. Cash value life insurance is the greatest savings vehicle, in my opinion, that's ever been developed by the human mind. Okay, because what they try to do is, right, and I'm sure you would agree with this, they try to compare it to an investment because that's the only way they can tear it down, right? They're comparing apples to oranges because they know all the other amazing benefits of cash value life insurance, then they can't hold up. It's actually, when they compare it to an investment, it's actually the meaning to cash value life insurance. So, anyways, that's my little rant on that.
Yeah, and it misses the point of what we're using it for. You can't look at any life insurance policy or any financial product in isolation. What are we using that vehicle for? One of the great things about whole life insurance is it's so flexible in how you design it. I can design it so many different ways. Okay. And there's a right policy. There's no like one right way to structure a policy. Okay. And if someone shows me a whole life insurance policy and say, is this a good policy? Well, my question is, what are you trying to do with it? How are we trying to use it? That's going to influence how I design it, right? In the design for, in this case, a 75-year-old and a 69-year-old life, obviously is very different from a 25-year-old. It depends, again, on what else you have going on. We have to situate it within your overall financial landscape. So this is where we're taking a big picture approach, and that's why I'm incorporating things in my analysis like long-term care. Like, hey, if you have a paid-off house at 75 years old, how about a reverse mortgage, right? Things like this that his financial advisor has not brought up, right? So it's not an investment, and of course, even if you were to compare it as an investment and fall into the trap of trying to reduce everything to return on investment, okay, there's a huge problem even there. If you look at the cash value in a life insurance policy and you compare it to money, let's say in the stock market, okay, and say, but the return on investment in the stock market is better. Well, no, you're assuming it's going to be better because nobody knows what the market is going to do tomorrow. How much risk are you taking on, right? This return comes with risk. This other return in whole life insurance does not come with risk, right? There's a guaranteed interest rate that you're being paid, right? Plus,
And
you're not going to pay taxes on this one,
and see,
right?
you make a good point. What I love to talk about is that because cash value life insurance, you're guaranteed to never lose any money. Doesn't that mean that every time there's a market correction, doesn't that mean you can access your cash values, wait for a cash or for a crash, I mean, sorry, and then write it back up, take your profit, get out, repay the loan inside the cash value life insurance policy? Couldn't you do that, whether it be with the stock market? You could do that with real estate. How can you quantify, in a way, how can you quantify the rate of return on doing something like that over a 50-year period? I frankly, I don't think you can, but that's the way they try to trash it, right? It's
Mm-hmm,
all about
mm-hmm.
ROR.
Right, right. And also another huge risk, especially for a 75-year-old, is the sequence of returns risk. Okay, even if you do average, 8% returns or whatever you're expecting, okay, when those returns happen is super important, right? If you want to retire and the year that you retire, the market crashes 30%, now you have a huge problem because now you can't afford to wait for the market to recover, right? If you're 30 years old and you're just starting, you can afford to wait 3, 4 years for the market to recover. Okay. And that you can see this, there are multiple studies on this to show the sequence of returns, where you can have the same average return over your retirement portfolio, over your retirement lifespan. But if those down years happen early on in retirement, it crushes you, right? Whereas if they happen much later in retirement, it's not as big a deal, right? So, and average returns are not real returns. Big difference there,
Yeah,
right? So even if you were to view it through that lens, you can't. It still, I think, looks pretty good by comparison because we're not taking on risk,
yeah.
right? And as
As
you
a,
mentioned, Peter, the whole thing that's really hard to illustrate is the fact that we have the policy loan feature, that we can access the cash in the policy without interrupting the growth in the policy and without taking on debt, right?
right. And as I say to people is, doesn't these bad downturns, we had one oh 01, oh 02, right? We had oh 07, oh 08. We had 2022, which will end up being, I think, the worst year for the bond market ever, right? So we just had three over the last 20 years, right? So, I mean, those were three times where you could have accessed the cash value, as my mentor has taught me to do, and to take advantage of those bad times. I mean, look at 01, oh 02. I think the Nasdaq lost well over 50% of its value or something like that. And I remember I got into business in February of 2002, like right as the massacre was ending. Well, that would have been a pretty darn good time to access the cash, income tax free, and stick it into the market, right? So,
Yep, yep.
yeah,
And so again, it's a bit of a rabbit hole, but you can use whole life insurance as a volatility buffer, so that you can now draw from your cash value life insurance policy while you wait for your market assets to recover. Again, not the infinite banking concept, right? but that is just one of the ways in which you can use a whole life insurance policy or a cash value life insurance policy. So yeah, yeah. And
And
so then
one
he
thing I just
says,
wanted to we just
go
want
ahead.
to
Yeah.
finish up with one thing you'd mentioned before, and I wanted to the sequence of returns. Tom Hegna
Mhm.
has an example that I share with all my clients. A guy, he retires. He has $100,000. Well, first of all, he has $100,000, 19, let's just say 73 or so. Puts $100,000 in, lets it grow. He makes averages 10.1%. He ends up with a whole pile of money. Well, we turn it around. Instead, he starts taking 5% out of that a year. He's making 10.1% a year. Well, he should never run out of money, right? No, he goes broke in 22 years. Why? Because the market went down in 73, 74, 75. Boom, boom, boom. As you said, he could never recover. Once you start taking money out of an investment portfolio in retirement, average rates of return no longer matter. Like you said, it's the sequence of those returns. Okay, you can continue now. I just
Yep.
wanted to get that in.
Absolutely, absolutely. A lot more we could say about that. But then the financial advisor again says something super bizarre. Okay,
What does he say?
ah, he says you're essentially making an actuarial bet that you die sooner than statistically predicted. I don't know where in the world this comes from. This is one I've not heard before. So what he's saying is, if you're taking out a cash value life insurance policy, you're making a bet that you're going to die sooner than statistically predicted. Now, I don't know of any life insurance agent that I'm aware of, even the bad ones, that would say that. I mean, that's just bizarre. So I don't know where this is coming from.
I don't know
Um,
because isn't
it,
that what underwriting is all about? Won't I always joke with people if you want to find out how long you're probably going to live, go get underwritten by a life insurance company because
mhm,
they
mhm.
actually they're not going to give you, if you get heavily rated, yeah, your life expectancy isn't great, but I mean this whole you're making a bet? No, right?
Yeah, and by the way, that's what when investment people like this talk about the market and so on, they're going to use that word bet. We're betting the market's going to go up, right? So they're telling you we're gambling. That's what we're doing. We're gambling with your money. And it's okay to gamble with some of your money. Like professional gamblers can make good money. Okay, maybe the bet pays off, maybe it doesn't, but it is a bet. We are not making a bet. Okay, it is important to understand that with whole life insurance, okay, you cannot lose. There's no way to lose. By that I mean, as long as you keep the policy in force, you or your heirs will always get more money out of the policy than what you put into it. Period.
With the way,
Okay.
well, just let me stop there a second. With the way we build them, they do. I was doing a review. I have to say this yesterday. Actually, I'm gonna leave the company out of it. It was a fraternal insurance company I used to work for. Okay, this guy he was rated, and actually, if he keeps the policy, he will end up. He's already paid in almost $19,000 of premium. Okay, it has a $20,000 cash. It's $20,000 death benefit. He's got $7,000 of cash value. He will end up, if he holds on to it, he will end up actually paying in more than what the death benefit will end up paying out, or it's going to be
Wow.
pretty much a wash. But because the dividend of that company, the dividend has come down since illustrated, and that it was rated. So most of the time, you're absolutely right. But I just wanted to mention that to people. It's very rare, but you could potentially pay in more, but it really shouldn't happen that way. That was just an oddball thing.
Well, and again, but the point I'd make is if you die earlier, if you die early on in the policy, obviously you got way more out of the policy than what you put into it because now that death benefit pays out and it's going to be significantly more than what you paid in. Hopefully you live a long time. And then what happens is the cash value grows to be significantly more than the premiums you've paid into the policy. And you can use that cash value while you're alive, right? Or maybe you have a long term care event and you can advance yourself a portion of the death benefit. But in any scenario with any of the policies of the companies I work with, you're always going to get more out of the policy than what you put
Yeah.
into it. So it doesn't matter whether you die sooner than predicted, when predicted, or live much longer than predicted. In any scenario, you're always going to get more out of the policy than what you put into it, right? Now, on the other hand, if you do die sooner than predicted, your investment plan might be completely blown up, right? If your plan is, I need to save this amount of money and I need to keep putting it away and hope the market goes up, and then you die before you get to the point where you've built up that savings, now you're in real trouble unless you have a vehicle like whole life insurance that's going to complete, we call it oftentimes a self-completing plan, right? When you take out a whole life insurance policy with, let's say, $1 million death benefit, you just started a self-completing plan to save $1 million, right? If you keep paying those premiums in, eventually you save up the money. If you die sooner than expected, then the death benefit pays out, right? And it completes the plan for you. Okay. But I don't know what he's talking about. No one is betting that you're going to die sooner than expected. I don't know where that comes from. That is bizarre. Okay.
I think
And
it
then
comes to
he's
show, though, Logan. I think it just comes to show how little he actually understands about it. Okay. I think that's important when you see things like this. Just like when you
mhm,
see some of these financial gurus on TV when they're talking about it.
mhm,
They act like they know all this stuff, and
mhm.
they actually know very little, right?
Yeah,
So
and I like how he throws in the word actuarial. Like that's a big word that's supposed to impress you. Like he
yeah,
knows what he's talking about, but he clearly doesn't know what the word means and the way that he uses it.
right.
An actuarial bet. Okay. All right. Clearly someone is not an actuary. Okay. So, and then he says, this is a bet often lost by the insured, as evidenced by the relative profitability of insurance companies. Okay. So here's an interesting thing. He's basically saying that, you know, it is somehow it's a win-lose proposition. Somehow when you go into business with an insurance company, they win and you lose because they're smarter than you and they're better than you. What? That's not how any good financial company works, right? It's all about win-win, right? When you
Right.
take out an insurance policy, you wouldn't say if I die early, I win, and if I live too long, the insurance company wins. It's like no, in either case, your insurance policy did its job, right? In a profitable, you want to work with an insurance company that is profitable. If a company is profitable, that is good. That is a good sign. They don't make profits by stealing from people. They make profits by doing good business, by having good underwriting and having good, high quality products that people are willing to buy. And oh, by the way, we are purchasing policies with mutual companies. So if that company is profitable, guess who benefits? You, the policyholder, benefit, right? That dividend that you're receiving in your policy is based on the profitability of the insurance company. So you want to work with an insurance company that is very profitable and has been profitable for a long time. One of the this particular insurance carrier that I was illustrating has paid dividends every single year straight for 170 straight years,
Yeah.
right?
And I'll
Show me a
also
Wall Street
mention
investment firm that has done that,
and
right?
I'll also mention we also have fraternal insurance companies. They can't even keep the profit, so they give it back. Here's one Catholic Order of Foresters, for example. But yeah, um,
So why is profitability a bad thing? I don't understand this. You want to
and
work with a company that's
and
profitable.
and
Duh.
by the way, I got one real good. So I love to carry around the Fortune 500. It just recently came out. Here it is. Okay. Now I'm going to read off the largest corporations. You can look this up. Walmart, Amazon, ExxonMobil, Apple, United Health Group, CVS, Berkshire Hathaway. Now, granted, Berkshire Hathaway, okay, they got some insurance companies in there. Alphabet, McKesson, Chevron are the top 10. Okay, outside of Berkshire Hathaway, did you hear of any insurance companies on that list for most profitable? And I could go down this list, by the way. JP Morgan Chase, by the way, a bank, is number 23 this year. I could get, Comcast, 29, AT&T. There's a lot of companies out there that are much more profitable than these life insurance companies. And by the way, does everyone realize that mortality costs since COVID, I don't think this is a coincidence, have gone up by over 10%? So actually the profits of life insurance companies are technically going down. Now the interest rates have helped offset that. But anyways, so I kind of think that's hilarious after just I just thought of that and grabbed it while you mentioned that. Anyways.
Well, once again, I reject his whole premise. Why is profitability a bad thing? You want to be working with a profitable company, right? I don't want to work with an unprofitable company that shows me the company is poorly run and has poor products. I want to work with a profitable company, especially if I'm sharing in the profits by way of the dividend, right? So yeah, so that's just bizarre. I'm not making a bet that I'm going to die sooner than expected, right? Okay, and yeah, the underwriters won't allow that, right? The underwriters are pretty good at determining the likelihood of you dying or not dying. Okay. So yeah, and then I give my answer. Which I just did. So then he says, insurance policies are historically poor investments due to fees, expenses, and caps on performance. Oftentimes, the insureds outlive the break-even point on the policy, at which time the policy becomes a sunk cost. This is so bizarre. Okay, so first of all, insurance policies are historically poor investments. Again, not an investment. So the whole premise,
Right.
as always, is wrong. Okay.
Once again, though, that is the number one thing. If you get anything, if you watch this video, you get one thing out of this. Understand that the way I was taught this, okay, back in 2002 as a financial planner at Wydell and Reed, okay, is you buy term, invest the difference. Cash value life insurance is a lousy investment. They always want to compare it as an investment every single time. It is not an investment. Never has been. We already talked about that a million times, right? But like you said, it just keeps on coming back to that one premise. That's the way they're taught. That's the Kool-Aid they drink, and they can't get past that. They're comparing it to an investment.
Right. Right. And they don't mention they don't mention risk, right? They just say, well, the investment's going to do better. How do you know? Prove it, right? And you're taking on risk, by the way. This is not taking on risk.
Right. And
Okay.
what
So
is
I would say the risk adjusted rate of return in a cash value life insurance policy is significantly better than an investment, right?
right.
But
And let's
they
face
don't.
it, well, investments are stocks and bonds typically, right?
Mhm,
So if we're
mhm.
going to break down stocks and bonds and actually get into this, let's talk about cash value life insurance is a wonderful, replacement for a bond, right? It's going to roughly do the same returns that a bond will do. If not, could potentially do better. I mean, look at 2022. The bonds got crucified. Most of the banks in this country right now are insolvent right now because of rising interest rates, and their bond portfolios are upside down. So, anyways, I mean, what does a bond have a leveraged death benefit? No, of course not,
Of course
right?
not. Yep. I
And
love
if
that phrase, a leveraged death benefit. That's kind of what I was trying to say earlier. When you pay your money into a policy, you are getting leverage, not in the sense of taking on debt, but if you pay in $10,000 into a whole life policy with $1 million death benefit, you just leverage your $10,000 into a future $1 million payout, right? When you invest in other vehicles, there is no leverage, right? The return you get is the return you get. Okay. Um, so yeah, and then he says, oftentimes the insurers outlive the break-even point on the policy. I have no clue what he's talking about there. The break-even point. I don't know what he's talking about. Maybe he's thinking that at some point the amount of money you pay in is more than the death benefit, which is pretty much impossible with the way I structure a policy and all that. I don't
right,
know what he's talking about. At
because
which time the policy becomes a sunk cost. This is so bizarre. I
yeah,
just don't
and
know
and of course, I
the
think we've
break
already.
even point. Like what does he mean? What does that even mean? The break even point. I
I don't
don't know
know.
what he's talking about.
So,
That is
look,
bizarre.
and let's face it, what we're typically doing is we're buying the least amount of life insurance and stuffing as much cash in it as possible. Whereas, you normally think you try to get the largest amount of death benefit, right? No, we're trying to buy the least amount that we can and stuff the most money in there. And that actually prevents exactly kind of what he's talking about. And by the way, whole life, you're typically getting all the expenses out. The expenses are front loaded in a whole life policy. And that first roughly 10 years is when it's going to be front loaded, right? Can be a little bit longer, but you're going to get most of the expenses out of it in the first 10 years.
Well, and again, to me, it's the wrong question, right? If I tell you, hey Peter, I'm giving you something and I'm going to guarantee you 5% return per year. I've just told you what you need to know. How much does it cost? Well, the net is you're going to get 5% per year, right? As an example, when you look at a whole life policy, the fees are all netted out, right? So you
Yeah.
can see what the performance is going to be. So if you ask, what does it cost? Well, I'm giving you the net after fees, right? So this is what you are going to get. So the fees, quote unquote, is kind of an immaterial question, right? It's sort of baked into the cake. But one thing that's interesting, as I'm sure you know, Peter, is when you enter this industry, and let's say you have a life license, okay, there's going to be pressure on you to get securities licensed because guess where all the money is to be made, right? It's not a selling life insurance, okay? It's taking assets under management, okay? In a typical life insurance policy, the agent gets a commission in year one, okay? And then after that, there's not much recurring,
Yeah.
commissions.
Small renewals. Small renewals.
Right. Whereas with investments, it's the opposite. That's where all that beautiful recurring revenue comes in, right? Because they're collecting their fees year after year after year. And I'm not criticizing them for that, right? Like I have
No.
no problem with people
And
making money. If you make a lot of money, that shows that you are adding a lot of value. So
and I'll
my
be
criticism of the standard Wall Street vehicles will never be because they're profitable. That's not my criticism.
and in my defense, my family, because I'm not the only one that's ever been in this business, my family's I know for a fact has made over seven figures on financial planning fees. So when I was growing up, um, I, I took advantage of it. I'm not against it. It's but once again, is yeah, having it all of someone's money just in investment. We just go back to the Ernst and Young report, right?
Mhm.
So that I've
Yeah,
already
and
talked.
what Right. And once again, I just want to be clear always because I'm rejecting the premise of what he says first. But then what he says is still wrong and has all kinds of misconceptions that need to be addressed. But the premise that, if you're profitable, that's a bad thing and you don't want to do business with a company that's profitable, that's ridiculous. Or that, charging expenses or fees is a bad thing. Well, all financial products have fees, okay? The question is not how expensive is it? The question is what value are you getting from it, right? If it's quote unquote expensive, but you get a ton of value out of it, well, those expenses are justified and it's still a great product, right?
But if you actually net out the fees, and by the way, let's face it, what the strategies we're building are not for someone for 5 years, right? I mean, they're probably going to have this strategy
Mm-hmm.
hopefully for 20, 30, 40 years. Similar to like a
Mm-hmm.
marriage, right? Till death do
Mm-hmm.
you part in a way.
Mm-hmm.
You net out those fees over 40 or 50 years, and I like to typically say you're going to be somewhere in the range of 0.5% to 1%. Let's even go 0.5% to 1.5%, okay? Over that time of period. You're going to be exactly the same as any investment account because the expenses on a cash value life insurance policy are front loaded. You're going to go look 30 years down the road when you got $1 million in cash value. You're going to be stunned at how little the expenses are in that policy. Whereas the advisor, he's going to be charging the same amount, and that's coming directly out of your account. So once again, cash value life insurance, the expenses are front loaded, but in the long run, it's typically about the same as any traditional investment, even though we're not trying to compare it to an investment. But that's such a, frankly, sorry, but BS statement that they always like to make it, and it's just not true.
And it's all projection, by the way, right? I'm never going to accuse them of, oh, you're charging high fees. Well, if they're adding a high amount of value, okay, no problem, right?
Yeah, compared
So
to
it's
what,
not
right?
about, yeah, it's not about the fees. And by the way, in whole life insurance anyway, you cannot parse out what the fees are. It's all opaque, which is good. It's a simple product. So it'll show you net net. And what you'll see is within the first few years of the policy, every dollar you pay into the policy results in more than a dollar of cash value growth. So at that point, I don't care what the fees are, you're getting more with every dollar you put into it, right? So where's the problem with that? I don't see the point. And again, no quantification. He just says, due to fees, expenses, and caps on performance. Okay, well, give me a number, right? Like fees, expenses, caps. Like, what do you think is reasonable? Like, what is compared to what, right? No number, nothing. And I'm glad Caps reminded me one of the things in our three-way call. He brought this up. He thought this was kind of like a gotcha question, like he's going to get me. He says, "What's the cap on this?" And I'm like, "Oh boy." I said, there is no cap. It's whole life insurance, right? There is no cap. Okay. But let me take that a step further. So my assumption is he's first of all, he's confusing different types of life insurance, right? Whole
Yeah,
life insurance doesn't
he's
doesn't have a
referring to
cap. Okay.
right.
But hold on. But again, it's isolating one thing, like, oh, it has a cap, therefore it's bad. So, but wait a minute. Let's say we were talking about universal life. Okay, there is a cap. What that means is, let's say there's a cap of 10%. If the market goes rip roaring up and goes 30%, you only get credit at 10%. Okay.
Yeah.
But there's a flip side of that. There's also a floor, typically a 0% floor. So if the market crashes down 30%, you get credited a zero. Okay. So there's a trade off there, which I think is awesome, right? Like if you gave me the option of, say, here, you can put your money in the market and you'll fully participate in the ups, but you'll also fully participate in the downs, right? Or I can put you in this other vehicle where you won't fully participate in the ups. You'll only get 10% of upside, but you'll get credited as zero if the market goes down. That sounds like a great deal to me, right? So again, he's always trying to look at one mechanic in isolation and say it's bad. Fees are high. There's a cap, therefore it's bad.
Well,
Well, we
it's
have to look at it holistically. Okay.
absolutely. It, he's going right off of the financial, the playbook that was written over 20 years ago. Like I said, that was the stuff I was taught in 2002. It's 2023 now, ladies and gentlemen. If your advisor, okay, I grew up on the financial planning side, all right? If you hear this stuff, think about it. They are literally going off of something that's over 20 years old. Do you want to get financial advice from somebody that's using advice that's stuff that's so outdated? I mean, and it was BS. Frankly, it was BS back then. Okay. But they regurgitate the same stuff. I've been hearing it my whole career, and I used to believe it, right?
Well,
So,
and again, all of his criticisms were too vague to mean anything. He just says there's high fees, caps, blah, blah, blah. Okay, that's totally vague. Like, can I see how it actually works, right? And I'll show them, here's how it works. And it's extremely competitive what it does, right? So all that becomes irrelevant, right? Um,
yeah,
so again, it's about the value that's being provided, right? We can't look at any one thing in isolation, right? I could criticize him by saying, hey, you're charging high fees. But I don't do that because I understand that means nothing in isolation. If the guy is getting you like 10, 12% returns like clockwork every year, well, great. He deserves his fees. I am not going to criticize other people for making money. That's what we're all here to do, right? And it's the abundance mindset rather than the scarcity mindset. The scarcity mindset says if somebody else wins, they can only do it at your expense, right? So if your financial advisor is making a lot of money, it must be because he's stealing from you. Not true at all. Okay, it's true across the board, right? It is the abundance mindset. The only way you make a lot of money in this business is by adding a lot of value to other people. That's how you make the money. Okay, that's the abundance mindset. Okay, the scarcity mindset basically views businesses and financial institutions as being completely parasitic, right? Where the only way they make money is basically by stealing it from them. So I reject the whole premise. If I hear a financial advisor makes a lot of money, I want to congratulate him and I would like to know what he's doing because he's probably adding a lot of value to people's lives, right?
right. No, absolutely. I mean, that's what free markets and capitalism is all about. You provide value, right? And you do the
Mm-hmm.
good things. I mean, I bust my butt, and I can say that, and I know you do too. I mean, we get rewarded for it, but at the same time, we feel. I mean, I feel that we're both worth the value we provide. I mean, that's
Yep.
so. And
Yep. And
by the way, I hate to get into the whole. I've really made a concerted point to not get into this commission versus fee based thing. I think it's I think it's malpractice in a way, to be honest. I really do. It's just not professional, and I could make the point on both ways. I've been on both sides of this. So
again, the question is, what value are you getting? That is the
absolutely.
question. If you go into Walmart and they tell you, here's the product and it costs $50, and then you demand to know, well, what is your profit margin on this? How much are you making off of this? They're going to say, look, here's the product. It's $50. If you're willing to pay $50 for it, great. If not, no big deal. Okay. The rest of it shouldn't really matter unless you have the scarcity mindset where you're like, I don't want anybody else to make money. And if somebody else makes money, I feel like they stole it from me. Right. I want the businesses I work with to be profitable. The local farms where I get my food from, I want them to be profitable. I don't want to steal from them, right? I don't want them to, slit their own throats, financially speaking, to give me stuff at the lowest possible price. I want them to be profitable so they'll do well and we'll all do well together. So that's a whole nother rabbit hole. But just to close it off, right?
Yeah,
The last
because
thing, and
we're,
we haven't gotten to the end of it, but again, we mentioned, he said oftentimes the insureds outlive the break-even point on the policy, at which time the policy becomes a sunk cost. That's completely bizarre. I guess what he's saying is that at some point you've paid in, if you have $1 million death benefit, at some point you've paid in $1 million, and now you've just lost all of that. That's totally bizarre. I don't see how that could ever
and
happen if you understand how actuarial math works.
I
The
mean,
reason why we
unless
call it a leveraged death benefit is
only
because
if,
that can't happen.
well, only unless that scenario I said earlier, which is a freak occurrence, where a company is actually lowering their dividend and actually it's a rated case, so they're putting a surcharge on the policy. Um, so
Peter, do you think it's possible that someone who puts money into the market with a financial advisor might get less out of it than what they put in? Do you
oh,
think that's
absolutely.
possible?
Gosh,
Okay.
look at look at the think of think of the poor Japanese guy that had all of his money in the market in 1989 when the Nikkei was at 39,000. Because you know what it's at now? It's like 10,000 points still. Has never come back since 1989, right? Think about that poor guy. And the Japanese live forever, right? That wouldn't be a nice picture. If your investments stay down for 20 or 30 years, what's your plan for that one? I mean, and it's never happened. It's funny. It's never happened in the United States, but we know the European stock market's been flat since about 2000. The Chinese stock market has been flat since 2008. We're like the exception. Actually, our chart looks very similar to the Nikkei right before the big crash of 1989. So, anyways, that's for a different. Hopefully we can talk about that another session. I know we got to wrap this thing up. So why don't you
Yep. Yep.
finish us up, Logan?
I think a lot of these themes are recurring, but again, confusing, pretending to be an expert in everything, right? Which is not. Confusing the infinite banking concept with cash value life insurance, right? Infinite banking is the strategy, specially designed whole life is the vehicle that we're using. And then again, viewing cash value life insurance as if it's an investment vehicle when it's not. And clearly, I mean, this guy is just saying some things that are completely bizarre. But I do think it was important that we hit on the abundance mindset versus the scarcity mindset. If I'm going to criticize another product or strategy, I'm never going to say, well, it's expensive. Well, that doesn't mean anything. Okay, what value am I getting from it? Expensive relative to what? Like, give me a number, right? So if you want to work with profitable companies and you want to work with people who make profits because they add value, right? So again, most of the time I'm rejecting his premise, but then I think it's also instructive to go into what he's saying because it reveals so many misconceptions about cash value life insurance.
Absolutely. So thank you for that, Logan. I hope everybody enjoyed this financial malpractice parts 1 and 2. And Logan, do you know what we got going on for our next video? Do you have any idea yet, or are we just gonna figure something
It's going to
out?
be part 3. There's more to go
Oh,
through. I have a whole email.
awesome.
Yeah.
All right.
Yeah. In fact, we'll probably publish the email at some. I don't know. I haven't thought that far ahead, but yeah, we'll do part 3 because we got more to go through from this guy. It's
All
great.
right,
Lots of
guys.
material
Well,
he's provided us with.
next week we will release financial malpractice part 3. So once again, thank you, Logan, for having me on, and I look forward to next week's episode.
Thanks,
See you
Peter.
later.
Bye bye.